All right, so welcome everyone. Apologies for that. My name is Pascal Bouvier. I'm the co-chair of the VC Club at the Luxembourg Private Equity Association. And today we have a workshop with Mircea and Kevin, who I will introduce in a little bit. And this is the second workshop of a series on digital assets. There's a first workshop that is recorded that you can find on the LPEA's website. That has discussed the legal aspects of either issuing tokens as a fund or investing in tokens and digital assets and cryptocurrencies, as well as the accounting, audit, valuation, financial aspects thereof. We had a partner with the DLA Piper in Luxembourg and a partner with Ernst & Young that discussed these things. And it was kind of like the base line to first understand how one can invest and what are the legal and accounting issues. Today, we are going to discuss compliance at large and market making, liquidity, and how does one invest in these scary things. We have Mircea, who is the CEO of Coinfirm. Coinfirm is a startup that is in market with an AML KYC solution, SaaS-based, for all transactions in the crypto blockchain distributed ledger space. And Mircea will discuss compliance and why it's not that scary of a thing, or it actually is getting less and less scary because more and more compliance is getting into the space. And then we have Kevin. Kevin is the CEO and co-founder of Keyrock, a specialist market maker slash broker liquidity provider for the crypto space. And he will discuss these aspects. For full transparency, my fund, Middle Game Ventures, is invested in both of them, which is the reason why I forced them to come in here and talk to us and educate us. If you could, gentlemen, maybe we'll start with you, Mircea, and then you, Kevin. You could introduce yourselves very quickly, and then we'll get into the presentations that you each have prepared for us, and then afterwards we'll do Q&A with the audience. So please, Mircea, introduce yourself.
Thank you, Pascal, and nice meeting everyone. Good afternoon, good morning, wherever you are. I'm Mircea Mihaescu. I'm the CEO of Coinfirm. I have been in software development and software technology for close to 40 years. I took over Coinfirm a little bit over a year ago to convert it into a company that can do a lot of good, and I'll explain what we mean by that in the crypto space and make it into one of the pillars of how the crypto community will evolve to. Thank you. Kevin.
Thank you, Mircea. Thank you, Pascal, for the introduction. Hello, everybody. Thank you for having us today. So my name is Kevin. I'm the co-founder and CEO of Keyrock, a company that we launched based out of Brussels a bit more than 4 years ago. Before that, I actually worked in management consulting in financial services. So we launched Keyrock 4 years ago with a vision to bring a scalable solution to bring liquidity to digital assets. We have a very strong vision of digital assets, basically replacing all traditional assets down the line. And we want to be a key part of that market infrastructure to ensure that we have market as liquid, fair, and efficient as possible. So of course, I will also through the presentation go into a bit more in details into what I mean with liquidity and efficient market, but that's the gist of it for us at Keyrock.
Very good. Thank you, gentlemen. Mircea, I'm going to tee you up with a really very easy question, right? We hear about on a daily basis about fraud, Ponzi schemes, manipulation, bad actors, financing of all kinds of nefarious activities, which means that crypto seems to be, at least for some people, like a big scary thing. You know, how do investors and service providers that are thinking about getting into the space, come to terms with that craziness that seems to be in the market? Is there no compliance? Can you not assure yourself that you're not entering a crazy world? I guess that's my question to you.
There are several angles to look at here. The first one is the size of the problem is greatly exaggerated by the press because it makes for good headlines. The reality is that the total size of illicit activities in the fiat world is about 1%. The total size of illicit activity in the crypto world on crypto rails is about, guess what, 1%. The total size of illicit activities in fiat is actually, if I don't talk percentages or averages, but I talk the actual amounts, is almost equal to the total amount that's being used for crypto activities, legal and illicit. So it's a completely different story. There's still a huge problem in fiat, and the market for tools for compliance in the fiat world, it's still growing at a compound annual growth rate of about 10%. So still a big problem there. But in the crypto world, it makes for good headlines. This being said, in the crypto world, with tools like ours, like what we develop, and there are another handful of companies doing this around the world, that our tools, they've just started to be adopted. The reality is that because of the nature of this technology, everything is in the open. In a sense, it's a blessing and a curse for the compliance officer. It's a blessing because all the transactions, all the counterparties, everything is out in the open, not only the immediate counterparty, but whoever has sent this money across many hops, where the money is going across many hops. The curse is, it's a lot of data. We are talking about, in our database, a petabyte of data. So you cannot do that in a spreadsheet. Clearly, some people are trying to do that, but they are slowly realizing of the size of the problem. So I would say that for crypto compliance, this is the place where you want to be if you don't want to allow illegal activities.
Thank you for that. Do you have a presentation for us?
Yes, I do. I'm going to share my screen. And here we go. So the company name is Coinfirm. We do crypto compliance. So let me explain very quickly, how did we get to this? So today it's a 3 trillion market. And I don't know, it may be 1.7 trillion yesterday, it may be 2 trillion. As you may know, there is a lot of volatility. But the key point is there are about 1 million cryptocurrencies. There are several $1 trillion of equivalent that has migrated there. There are between 200 and 300 million people that own or trade these currencies. So it's not something that we can ignore. This is something that's happening, has been happening for a while. By a while, I mean years. Someone who has bought Bitcoin 10 years ago is probably now a billionaire. But this is an activity that's growing, and it's growing every day. Now, is it regulated? Is this something that, wild, wild west, where everybody can do whatever they want? It's actually not like that. There is a group, an international group called FATF, that is providing pan-national guidelines. There are regulators in each country that are now, in a sense, waking up. Smaller jurisdictions like Singapore and Gibraltar, they have been at the forefront, but also in the US, FinCEN, there is FCA in the UK, there is BaFin in Germany. We work, these are the names that I know because we work very closely with them. We work closely with the European Union. We are providing input into the recent attempts to regulate. Of course, Council of Europe comes with one set of directions and the Parliament with another one, and they both talk with us and we help. So legislation is coming. It has been a free-for-all for a while, but it's impossible to allow trillions of dollars to move around without some kind of, and we call it money laundering as a, let's say, a handle for the collection of what I call illicit activities. They include terrorist financing. They include buying illicit drugs, any kind of dark web. So all kinds of activities are happening in fiat and in crypto, and they are being regulated. And of course, there is taxation, and you may have seen, if you follow, that the current prices, market prices of various cryptocurrencies has been going down in the past month. My view is that everybody is selling to pay taxes, because now they have to pay taxes, and everybody needs to do that, and they're not going to pay from their fiat, but selling the crypto to pay taxes on crypto gains. Licensing, there are over 70 regulators that we are aware of that provide licensing and requirements for various vast virtual asset service providers that work in each jurisdiction. We know of over 30,000 entities that are either licensed or are in the process of acquiring a license. Out of those 30,000, about 6,000, we see them active. So this is now moving in the right direction. Yeah, you don't want to deal with fly-by-night operators, and it's all happening. Who has to do this? Yeah? There is a term in money laundering called obliged institution. The obliged institution is someone who has to follow the regulation in order to exist. Otherwise, they will be shut down by the government. So exchanges, custodial wallets, payment processors, and other services like lending, gambling, where they accept payments in crypto, all those are already regulated. Decentralized finance, not. Also the protocols and asset issuers, because it's decentralized, but someone has written that contract and posted it on a DeFi platform. And this is a big problem, non-custodial wallets. Non-custodial wallets is the equivalent of holding cash in your wallet. So you pay cash, no one knows who you are. That's a non-custodial wallet. And we see European Union attempting, at least in the initial drafts, to regulate that. We think that that's actually not going to happen. It's impossible technically, but this is the field. So it's already happening. If you deal with already regulated entities, you are under the protection of the law, so to speak. The problem is today, because very few market participants used to, like ours, 90% of what's happening illicit activities in crypto, they are not being detected. All of us together, like I'm talking ourselves and our large competitors, all of us together, we have like 2,000 customers. So think of that, 30,000 entities that are licensed or in the process of being licensed. Only 2,000 have bought a tool like that. The rest, they think that they don't care. Yes? Okay. Now, this is very clear that we can see what's going on, and I'll explain that in a moment. So privacy is one thing, anonymity is something else. It's not anonymous. With algorithms, we know exactly who's doing what. Yeah, you may have seen news about a hacker group sponsored by the North Korean government. We have the collection of all the transactions that they have ever done and all the addresses that they have used. Yeah. And of course, the problem is still collusion. And this is where you see in fiat happening, the same thing happening in crypto. So only proper regulation and enforcement of regulation will help. In fiat, and this is data that I have from fiat, is still a huge problem. Yeah, it's still billions of dollars in fines. And recently I've seen another large bank, and banks like HSBC and BNP Paribas and JP Morgan and so on, they pay money. It's almost like cost of doing business, yeah, in fiat. Yeah? So of course, in crypto, there is a problem. So in market in general, yeah, on the left side, crime, fraud, money laundering, uncontrolled capital, of course it happens. Yeah? It's like there are people that dedicate their lives to try to steal. Yeah? This is happening. The problem is there a firewall? And the firewall has many elements. We don't do all of them. We are partnering with a lot of companies in the KYC space, in the market surveillance, detecting attempts to manipulate the market. We are working with the regulators, FIUs, financial investigation units, with law enforcement. What we do specifically is AML and fraud investigation. What was that a question? No. Okay. So now this is the firewall that makes everything with blue happen. Yeah, that's the useful activity. Now you may want to decide for yourself if gambling is useful, but society does it. Yeah, and everything else is a part of the, let's say, the real economy that the crypto rails is supporting. In traditional finance, yeah, banks don't see what's going on. Yeah, they have to or any financial institution, they see a SAR, suspicious activity report. I'm using the example of, oh, if someone comes with a suitcase with $20,000 and makes a deposit, that's a big problem. Yeah. However, there is a wire coming, and the wire is $5 million, and it's coming from a known entity with their account at Citibank. Everything is fine. It's actually not fine. We see where that money is coming from. It's not only the source of funds, which is the first hop in the transfer of money, but what we call source of wealth. Where did that money actually come? You can. It's almost impossible to do it in a traditional financial system. You need to have a lot of people subpoenaing a lot of banks to get that information, if ever. In blockchain, in crypto, this is possible. So how we do it? Yeah, we collect a lot of data on chain. This means from blockchains, and we support 20, and we'll have 40 by the end of the year. Pretty much everything that's happening. Now, when I say transactional data, just to give you an idea, there are about a billion addresses on the Bitcoin blockchain, and they have trillions of transactions. There are about 250 million addresses on the Ethereum blockchain, on the Ethereum virtual machine, and there are about 4 billion transactions. So this is just the two largest. If you add up everything, you end up with our 1 petabyte of data. Everything. Now, everything needs special technology to be able to even make sense of it. We also collect a lot of off-chain data. That's how we know about the hackers. That's how we know about who's a legal registered entity and who's not, who has KYC and who has not. And we combine all off-chain data with all the on-chain data, and we run our algorithms to determine risk. So we provide to our customers a view of seeing, is this counterparty that I'm dealing with now, they are sending me crypto, they invest in my fund and they send me 10,000 Bitcoin, I wish. Or I need to pay in Bitcoin. Who are these guys? And we can do the calculations and tell them what is the risk. Yeah? So we do, and the cornerstone of what we do is we detect the risk of a blockchain address. Yeah? And our customers will take this string of numbers and letters and put it into our system, and we tell them the risk is low, the risk is high, the risk is medium, and why. We calculate over 300 risks. So it's not like you are driving blind if you are in this space. There is a metaphor that I've used many times, is when governments first tried to enforce seat belts in cars. There was a huge outcry that it's my car, I do whatever I want. And other people are not driving cars because it was very risky. You know, what if you get into an accident? So seatbelts sort of solved that problem. Here is, and we see financial institutions that don't touch crypto because it's risky. Actually, with proper technology, it's not that risky at all. It's actually a lot less risk than in fiat. Yeah? So we verify an address, we verify transactions. Now, transactions, very careful because there are trillions of them. So you cannot, it's like a needle in a haystack metaphor, or even worse than that. We also check pools of addresses. If you're in the business or read about this, you are aware, for example, of liquidity pools, and they pay a yield. We also look at who is the owner, because in the end, it's not the address. The address by itself is like an account number. Who controls it? Yeah, so we know about that as well. Yeah. we calculate what we call a C-score, which is a risk calculation that we determine. And you can see that the vast majority of the calculated ones are in the medium, they are with yellow, which means that they are probably okay. They may have interacted with some funds that have been linked in many hops to some illicit activities, but overall, this is okay. And these are the addresses that we check. So we check maybe a quarter of all the addresses, because all the others, like 3/4, they have zero indication that have anything risky in them. So we do a first pre-sort, and after that, on the ones that are definitely not zero risk, we run. Still, many of them are very medium risk. So this is about who is doing this kind of things, illicit activities. It's still a small number, relatively easy to detect. So what do we detect? And this is an example on the right of the screen that our customers get. We detect if the address owner is a problem, if there is a transactional pattern, like this is like sending $1,000 equivalent of Bitcoin every hour for the past 3 days. That's a transactional pattern. Is this related to sanctions? You may have seen recently a lot of entities and people being added to sanctions list because of the war that Russia has started in Ukraine. So a lot of Russians are now on the list. We had to almost daily update our lists. We also give our customers a lot of informative flags, like about the business that the counterparty is running. And some of our risk decreasing factors. For example, this entity has just been regulated. So BaFin just verified Commerzbank, and Commerzbank is now very low risk because it's a regulated entity outside the fact that it's a very large bank in Germany. So all these things we do calculate and we tell our customers. Now, and this is, I think, my last slide. While we do help our customers and the market in general with preventative activities. So what's the risk of doing business with this entity kind of question? And compliance officers are the ones that work with our software to detect this kind of things. If something happens, we also help, because in the end, it's the same data, just the algorithms are different. So we have customers, for example, that decided to pay ransomware. They paid it because otherwise they would be out of business. We can take that transaction hash of the payment to the Lazarus group and find out where did the money end up. And if the money ends up in an unhosted wallet, we keep monitoring it for any kind of change in real time, because they cannot use money in crypto in an unhosted wallet to go and buy a Lamborghini for the dear leader. The moment they are moving that money to an exchange and try to get cash, that's where we detect right away, and we automatically tell the exchange, Kraken, for example, that someone is is in possession of stolen funds, is attempting to exchange that for fiat, and please freeze this attempt. So we have over 100 cases that we have conducted, including some of the large ones, and we have about 70 in progress right now. The point being that it's both the preventative, which is the compliance, and the investigation in case an illicit activity has happened. So all this is possible in the distributed ledger technology, in, let's say, blockchain, because as I said initially, everything is public, everything is out in the open. If you understand what you are looking at, there is a lot of information that will help you manage your risk. So this is in a nutshell. And are we doing questions now, or?
We'll do it later. We'll have Kevin come through. Thank you very much, Mircea.
My pleasure.
Kevin, it's up. You're on deck. I'm going to tee you with the bad V word, volatility. I think that Mircea mentioned that term, right? Things seems to be absolutely crazy in the crypto digital asset space, whether you're talking about tokens, whether you're talking about real cryptocurrencies like Bitcoin, or whether you're talking about Ethereum, in the Ethereum, like, tokens that are being built on Ethereum. I look in yesterday and it's a price X, and I look today and the price went down by 50%. And then I look tomorrow and it'll have gone up by 30%. So, I mean, that is not something that is comforting for people that are contemplating going into the space, especially when these people are institutions that are used to, you know, not as crazy a volatility and liquidity structure. And so my question is, you know, what the heck is going on? And should people be afraid, much like, you know, should they have been afraid from a compliance and risk perspective?
Sure. I mean, to be fair, I run a trading company, so volatility is not that much of a bad word for me, to be honest. But still, of course, when considering different type of investment profile, it is something to be considered. And I have a small presentation actually, if Johan can share it. The start of it will take a bit of a look back, which also kind of to some extent addresses these volatility questions. So I say for this chat today, so I remain relatively brief so that we have some time for questions at the end. But I start with having a quick look back on the market and the reason why we're actually, you know, looking at it with a lot of interest. But also exactly to your point, we are not in this simply for the short-term volatility, but it would be interesting to understand what is the long-term vision. And, you know, what is the reason why we can tolerate short-term volatility, because we have a longer-term outlook of what this market is and what this technology can actually provide. I'll then go into liquidity, just explaining briefly what it is, how liquid digital assets are today, and then I finally go through two different things, two main topics that need to be, you know, considered by investors that are willing to enter this market, knowing that the third very important one, which is of course compliance, has already been addressed by Mircea. So if we take a quick look back, so on the next slide. So Mircea mentioned, you know, the size of the market today. If you look on the last 3 years, basically the size of the market has been multiplied by 12, right? So yes, of course, you know, this chart that you're looking at is not a very stable upward slope. There's a lot of up and downs, a lot of short-term volatility. But if you take actually a bit of a step back and look at, you know, how has it been developing on the longer term, it's basically been an extraordinary growth story overall around digital assets, you know, at large. If you go on the next slide, please. You see that not only has this, you know, market been growing in size, we see that the adopters have gained in credibility too. I mean, when I started to be involved in digital assets, so it was back in end of 2014. At that stage, basically crypto was only for drug dealers, right? And then we started to look into a bit broader term. A few months, a few years later, crypto is now for small unregulated companies, and it went from that to being only for small banks, and now we're saying that it's only for small countries. So it's always for small something, but we can see that something is actually dramatically growing in size and dramatically growing in credibility. So not only do you have a market that overall is growing tremendously fast, you see that the persons and the stakeholders within that market are more and more credible. And this is something you would expect it that has been, you know, noticed by investors. So if you go on the next slide, you can see that the combination of this, you know, fast-growing market with an ever-increasing credibility of stakeholders, you end up with a rate of investment in the space. So here, looking at cryptocurrency and blockchain companies, that has been, you know, dramatically increasing, going from a bit over 5 billion in 2020, invested by, you know, by VCs mainly, to something that is just below 30 billion a year later. So we do see that, you know, the trend of growth and the credibility of stakeholders has been driving a lot of investment in the space. So now the question is why, right? I mean, of course, having the possibility to make a nice multiplier on a 6 months, 9 months, or a year horizon is nice. But as I mentioned, if you just look away from the short-term volatility, there is an underlying story to be seen here, an underlying long-term vision, which we'll address just next. So if you go to the next slide, and actually the one just after that, if you consider a digital asset, basically, and so yeah, the previous slide, sorry. Thank you, Johan. So if you consider everything else being equal, a digital asset is basically a superior asset to a traditional one, very bluntly said. And to illustrate that, we look at one example. So if you take an Amazon share on the traditional market, right, just an Amazon share as it is today, it gives investors protection. It gives it a clear regulatory framework, it requires many intermediaries to be traded with the associated costs, and the additional constraints is dependent, of course, on banking hours and is not fractionable. Now you take that same share, that same Amazon share, and you have it fully digital. So you have that share being represented by a token, a digital token on a blockchain. All of a sudden, you end up with basically an asset that gives the same rights and the same information to the investors, but on top of it can be traded directly peer-to-peer, can be transferred 24/7 anywhere in the world at almost no cost, and is fully fractionable. So the long-term vision here is that the technology that is behind cryptocurrencies, the blockchain, the distributed ledger technology, allows you to create fully digital assets that are simply inherently superior to any traditional asset today. And this is because, as I mentioned here with this example, it has basically three main advantages, which we'll see on the next slide. It can be easily traded. A digital asset, so today crypto, tomorrow a digital Amazon share can be traded peer-to-peer, or it can be traded on a centralized exchange, or it can be traded on a decentralized one, basically as you prefer. So that asset, because it is fully digital, is now a lot easier to trade and to exchange. It can be completely fractioned, so you can invest whatever you can, starting with the investment as small as cents. You can do that in any type of asset that is digital, and you can do it without depending on an innovative broker. Because you would tell me that, of course, today, in Western Europe, in the US, you can do that on Robinhood, right? You can buy 1 cent of a share, but to actually do it, you are dependent on the willingness of Robinhood to make this a feature. If you have a fully digital asset, you can do that basically no matter what broker you use. You can do it peer-to-peer. I can sell 1/100th of an Amazon share to Pascal without going through any type of intermediary. And then finally, you have very low transaction fees. So as you have an asset that is fully digital and issued through a blockchain, you can basically skip any intermediaries that you want in the investment and in the further transactions. So the brokerage fees, the clearing, the settlement fees, the bank transfer fees, and so on and so forth. So going from traditional assets as they are today, electronic, yes, but completely centralized, to fully digital assets, you end up with assets that are inherently superior, inherently easier to trade, and with much lower barriers to investment. So this is basically kind of the long-term vision, the reason why you can bear with short-term volatility, knowing what is basically the silver lining in terms of market development. If we move forward, so I've been talking quite a bit about the market and how easily tradable. We do see that this long-term story brings us towards a complete shift of all traditional markets to digital assets. This is, of course, the vision that is underpinning the development of Keyrock, but this is how we see the markets developing as a whole. So you have here on the left, the total financial markets have a size that is around 225 trillions. You have on the right what is now the small global crypto market cap that is around 2 trillion. So we do see the potential for growth that is quite gigantic. And not only do we see the growth of the numbers of market caps, we see a lot of companies actually making the jump in the middle. So the crypto world is not simply something completely separate that we don't dare to touch with a pole, but it is actually more and more being recognized as the future of capital markets as a whole. Moving forward towards liquidity and what liquidity is and the role of markets. So if you look at the market, basically its main added value is going to be liquidity, right? So the ability to easily transact, easily exchange any type of asset that you either want to acquire or that you want to get out of. So if you go on the next slide, we're going to have typically on an exchange, on a trade, on one side, we're going to have a seller that wants to sell 5 stocks at a price of 100. On the other side, we're going to have a buyer that wants to basically buy the same stocks at the same price. You would think that that's a match made in heaven, right? You have a buyer, a seller that want the opposite thing at the same price. You're just going to have a transaction. The market is liquid. Everything is great. The problem is that you have a bit of a barrier in the middle, which is time. So it's actually very rarely happens that buyer and seller just organically meet on the market and create a market that is liquid on which they can easily transact. Of course, that liquidity is at the benefit of everybody involved. So if you go on the next slide, we'll see that it's in the interest of all parties to have a market as liquid as possible. It's in the interest, of course, of traders and investors because they want to be able to easily increase or decrease their position. They want to be able to get the best price even for high volumes, and they want to have a decreased risk of price manipulations. It's in the interest of issuers, of course, so the companies that create the tokens. They want to have a higher attraction power for investors. They also want a decreased risk of price manipulation, which is the case the more liquid the market is. And then finally, of course, it's also in the interest of exchanges, because the more liquid the market, the more transaction, which means the most revenue for them, right? So basically, every single stakeholder in the market wants this market to be as liquid as possible, because liquidity is basically the one added value of markets as a whole. As I mentioned, we often see a time barrier in the middle between buyer and seller, which prevent that liquidity. And this is where market players, market makers, such as Keyrock, actually come in. So if you go on the next slide. As market maker, what Keyrock does is that basically we bridge the gap between traders to ensure that we have liquid markets. So when the seller comes in on the markets willing to sell, Keyrock is there to buy. And basically we're going to hold on that stock until a buyer comes in and we are there to sell. So we ensure that we can have seamless transactions between buyer and seller. And this is what we make as a market maker, providing liquidity. Today, we do this on more than 80 trading venues everywhere in the world and are trading 24/7 on more than 400 markets. This is how we, Keyrock, as a market maker, participate to the healthiness and the infrastructure of digital assets. The question is, how effective is that, right? How liquid are digital assets effectively? You as an investor that want potentially to invest, how liquid are the markets today? So if you go on the next part of the presentation, we'll have a quick look at the most liquid digital asset, just to give you a sneak peek of where we currently stand. So this chart here is looking at the liquidity on Bitstamp, so on Bitcoin Euro, right? So I've taken a Bitcoin Euro as given who is here on the around the table, and Bitstamp as a regulated institution in Luxembourg. So if you look at the liquidity on Bitstamp, you can see how much you can actually buy and sell on Bitstamp within 1% of the price. So if you take a data point towards the end of this chart, the 25th of April, at all the way on the right, you can see that you are able to buy 91 Bitcoin without moving the price up by more than 1%. So that basically allows for people to make at once on Bitstamp only trades that are superior to 4 million euros without moving the price by more than 1%. So you do see that even on those singular exchange, you do have quite some decent liquidity in the order books and the ability to trade at relatively high volume. Now, if you go to the next slide, you can see that this is Bitstamp only, but basically, digital assets are quite fragmented. You have many different exchanges that provide the same listing. So again, here, if you are looking at Bitstamp, so this is the second in that list, you see on the buy and the sell side, something that is around 60 Bitcoins in liquidity within 1% of the mid price. But then if you look at other exchanges, such as Kraken, you can see that the outstanding liquidity is actually much bigger. So if you have the ability to aggregate those together, you essentially can dramatically multiply the available liquidity on digital assets. This is the case here. So I've been looking at Euro. If you look at US dollar, for example, on the next slide, you will see that we go for numbers. This is still on Bitstamp still. So we go from numbers where we're around a bit more than 60 towards more than 120 Bitcoin of liquidity on the Bitcoin USD on Bitstamp. And then next slide again, if you look a bit broader than that at other exchanges, you can see that again, the multiplication is quite immediate in terms of the liquidity that you can get if you are able to aggregate multiple exchanges together, right? Next slide, please. So having this in mind, right, we are on a market that does provide liquidity, even more so when you are able to aggregate it, which means that if you are not, you expose yourself potentially to some risk in terms of lack of liquidity, right? So the first thing that you need to have in mind as you potentially want to enter this market and invest is execution. Are you going to execute your trades alone, or are you going to do them through a partner, right? So you have two schools of thought. If you do decide to execute yourself, there are, of course, a few risks that you're going to be exposed to in terms of fees. You're going to start with fees on exchanges that are going to be relatively high as you have low volume that you're traded. You're going to have limited liquidity. Basically, if you create an account on Bitstamp and you want to buy Bitcoin for Euro, you only have access to that Bitcoin Euro liquidity on Bitstamp. You don't have access, of course, to all the other exchanges. Therefore, the price that you're going to get is suboptimal, because it might very well be that at a given time, the price on Kraken is actually more attractive than the price on Bitstamp. If you are only trading on Bitstamp, you don't have access to that displacement in prices, and therefore you're not acquiring digital assets at the best price you could be getting it at. Then finally, you're going to have some operational load. You must open and maintain accounts. in at least one exchange, as those exchanges are a regulated entity, as was rightly pointed out by Mircea. You're going to need to follow the KYC and AML policy and make sure to keep that account always up to date. And you can basically not very much optimize your execution. You're just going to go on the market, put a buy order, and wait for it to be executed. If you do this through a service providers, what will be possible there? Partnering with a company that can provide you liquidity, you're going to have lower fees, of course, as that partner would be trading high volumes and therefore be trading almost for free on exchanges. You're going to have a limited liquidity, actually, because the partner will have access to a broad set of exchanges on all assets. As I mentioned, so Keyrock today, we're trading on more than 80 exchanges. So if I want to buy Bitcoin today, I'm going to do it making sure that I get the best price across more than 80 venues. And in terms of operational load, of course, you have only one single onboarding to do with that partner that can also, in the end, provide you optimal execution. So with time-weighted average prices or volume-weighted average prices, making sure that if you want to buy a large amount of Bitcoin, you are not simply dependent on the price right now, but you can optimize that trade execution over longer periods of time through the trading algorithms of your execution partner. So that's first decision to be taken. Do you want to execute alone or through a partner? And the second one that is actually also a very key point is on the custody side of things, which also is described on the next slide. You can decide to do the custody alone or through a partner, but I'm not sure if that really is an actual choice, an actual question. As investment professionals, I'm sure you wouldn't like to do your custody under your mattress, right? Even though it's nice because you save a bit on custody fee, you are of course taking an enormous risk and require some tech knowledge in order to make it to diminish that risk a little bit. Of course, on the custody with a partner, you have a small custody fee to pay, but you are dealing with custodian professionals that also offer some insurance possibilities. So this is something on which you can very easily on the market as well find very serious and well-established custody providers, basically. So two main choices as you decide to open the market. How are you going to be working on the execution? Of course, a slightly biased view on my side, given our activity at Keyrock and the market making and the liquidity provision that we do, I would of course always advise you to do it through a partner if you want to be able to get the best execution. Same thing on the custody side. We don't offer custodian services, but I would most likely also always advise to go through a professional custodian once you have actually entered the market and are holding digital assets. So that's it on my side. If you have any questions regarding liquidity, Keyrock's role in the market, or other things to consider when entering, more than happy to address them.
Very good. Thank you very much, Kevin. We have 13 minutes or so, so we can entertain questions from the audience. So anyone in the audience, raise your hand and ask your questions if you have one to either Mircea or to Kevin. Anyone? Right. I'll start with one then. The two of you mentioned on the one hand DeFi self-custodied wallets, right? And on the other hand, peer-to-peer buying and selling, right? So for Mircea, how are you going to solve this? How is the compliance industry going to solve that nut so that it is at a certain threshold of acceptability for compliance and risk? Because it would seem that if it's impossible to regulate and to create a certain level of compliance, there might either not be adoption on the institutional side, or there might be an outright ban, and these activities would happen, in the dark corners of offshore jurisdictions. So that's my first question to you, and then I'll have a follow-on question to Kevin on that same subject.
Yeah. So then, not hosted wallet is the logical equivalent of any of us having cash in hand and in our wallet. Yeah, and we can go and exchange cash with people, even buy. But the moment we want to do it a larger amount, yeah, the counterparty will already see the risk. Yeah, so you're not going to go and buy a car and come with 40,000 euros in a suitcase. Yeah, so it's usually for small amounts, and that's impossible to regulate. And any attempt to make that regulated will fail, mainly, as I mentioned that because because of the technical reason of how do you even keep track of that. However, the moment we are talking about significant financial activity or using financial products, those wallets will need to interact with the existing infrastructure of players, of entities, and most of them are regulated. The issue stands with, so if you want to exchange with cash, they will have to check on you, the centralized exchange. The issue is on DeFi, yeah? And on DeFi, why we will be providing the counterparty risk based on the address risk score, and this is a product that will launch this week, actually. The identity of the person that controls that wallet, it's a problem that's not solved to that today. We expect the industry will evolve in the direction where there will be a collective that will set up a central repository, distributed repository, where if you want to interact with the DeFi smart contract to get yield, you will need to provide your KYC, CDD to some parties that will aggregate all that. So when you do that kind of transaction, you just say, I'm validated, without actually saying who you are. So it's delegated to another smart contract that will act as an oracle and say, yes, it has been validated by me. And that by me can be, for example, BNP Paribas can provide this kind of service for their customers because they already do KYC and CDD on their customers, all the unhosted wallets. So once you interact, it's not Pascal who does it, but BNP Paribas has confirmed that this unhosted wallet is controlled by someone that we know is not an illicit activity player. So this is the direction. We are not there now. There are attempts to regulate all that, but I think what I described is a much more doable and most likely course of action in the next, I don't know, couple of years.
Got it. Question for you, Kevin, which piggybacks on the question that I asked Mircea, right? So the thesis that you have explained is, well, sure, there's like high volatility now, but as the market grows and most, if not all, assets become quote unquote digital assets that are tokenized, right? The market structure will essentially be, digital assets, and so by definition, volatility will decrease. At the same time, you said that we'll have the ability to affect peer-to-peer transactions on a variety of digital assets, right? How does, I'm an investor, I have my fund, I'm institutional, I can do peer-to-peer, but how does that decrease volatility, or how am I able to do peer-to-peer transactions if by definition I don't have like an overall view of the market, which you rightfully said, right? You have to find the right service provider that provides you with the most liquidity. But if you do peer-to-peer, you don't do that, right? You have like another peer, and it seems that you don't solve for that volatility. Or am I missing something?
Yeah, I mean, the thing, of course, is that if you look at the overall volatility on the market, what is going to decrease it is to have, the most possible flow, that being, peer-to-peer or through centralized or through decentralized exchange. But this only holds with the assumption that you have an information that is as complete as possible, right? So even if you do a peer-to-peer transaction, knowing that all the other ways to transact on centralized or decentralized exchanges are fully open to both parties, you would expect the two parties to make a transaction at a price that is in their best interest and that is aligned with what they could get, otherwise on the market. So this is where I see that the fact that you have peer-to-peer possibility of transacting is not, solving per se any problem that you would see today, but just adds kind of a more optionality in the ways of transacting. But it would be very well possible that somebody is willing to buy a Bitcoin off of you at 120,000, which would be an unwise investment move, knowing that you have hundreds of different markets when you can actually get them for half the price. So of course the expectation on peer-to-peer transaction is that those transactions would still be made with a correct price information on other venues where the same transaction can be made. It simply adds optionality compared to what you see today, where today if I want to buy a share of a publicly listed company, I have to go through my broker that will be trading on a certain venue at a one price. On digital assets, basically that option is that obligation is no more there. You can do it peer-to-peer too if you want, but that's still of course the price that you would get would in most logically be aligned with what you see on the rest of the market. And of course, when I say most logically be aligned, that alignment is made possible basically by players like us that will continuously be trading on all types of venues, making sure that the prices actually remain aligned.
Got it. We have 5 minutes and then our time is up. So given the audience in Luxembourg, so either investors or service providers to the funds industry, I'll start with you, Mircea, and then Kevin, if you can answer the same question. Mircea, what would be that one recommendation for a new investor that is contemplating getting into crypto for a certain portion of what they are investing? And the same for a service provider that is contemplating providing services to a fund that is contemplating making investments in this space. That one recommendation that you have.
Yeah, and the recommendation is pretty clear, and I'm using it with a lot of our let's say prospect, which is do your own research, talk with the people in the industry, like exactly what we are doing now. We have seen maybe 80% of the people that approach us, they don't approach us to buy anything. They approach us to find out what's going on, like the more detailed description of what I have just provided. Yeah. So I encourage each of you under no obligation to contact me, you or first people you work with, to contact me, to contact us. We'll tell you more. Yeah. For free. This is like, we know that in order for this to succeed long term, we need to explain what we do. So we'll not be pushing you to buy from us. We'll just tell you what needs to happen for you to do this within regulations and to intercept the market when it will grow enough for your satisfaction.
Same question, Kevin. What's your one recommendation for someone that is contemplating getting into the market?
So I'm, starting from the hypothesis, of course, that everybody on the table has the level of, professionalism to mitigate all the risk, in making transactions and, doing his own research and, learning about the market that they are looking to invest. But on that hypothesis, my main recommendation is to stop contemplating and to start doing. Like, I think that we are at a stage where it's no more about a small risky asset class that seems to be, interestingly growing. This is the same type of paradigm shift that we had when we went from paper trading to electronic trading. I think that is not about looking from afar something kind of interesting and cool. It's the technology that will completely disrupt all capital markets. So as investment professionals, I would definitely recommend to just get into it as early as possible.
Thank you, Kevin. We actually have one question from the audience. Luis.
Yes, I want to raise a question because I would say 3-4 years ago, in LPEA meetings that we had, either with GPs or with family offices, anything related to blockchain and crypto world was dangerous, and it was almost a taboo. Huh? No one wanted to speak about it. It's not even a subject. Gradually, we've seen more investors exposed. I'm not even speaking of funds, but say family offices getting exposure. But this is something that needs to be institutionalized. So, because even family offices, they have internal procedures. So there always must be a control process, a verification that this is somehow safe. So what kind of internal education needs to go through these teams that want to approach the decision makers or the investors about investing into this space? Because there's still volatility, uncertainty, points of insecurity, as you were trying to address, Mircea. But what's kind of the the selling points they need to use to sell these new asset class internally.
Kevin or Mircea, whoever wants to take that.
Yeah, I mean, I can start. I think that, you know, on like two different sides of your question, right? On in terms of what is the education that needs to happen. I think that, you know, Bitcoin was created in 2008. So now we are, you know, 14 years later. There is an absolute wealth of information, you know, around the asset class, the actual infrastructure that is starting to be built on the market, and how to do this. There are entire industries that are being built around, you know, educating on digital assets and what they allow. So I think that, you know, quite luckily, today we see that there is a wealth of information that is publicly available for that education to be possible to happen. I think that you mentioned institutionalization. I think that the type of market infrastructure that we see now compared to four years ago, when we started the company, there was no partner for execution, there was no KYC and AML tools, there were no custodian, there was absolutely nothing. I think that we are at a stage now where that institutionalization in terms of market infrastructure is actually possible. And then the last point is what is the selling point of you know, to go see those decision maker. I think that it's a bit getting back on what I said just before. This is a technology on which all financial markets will be built in the next 10 years. So this is something that simply cannot be missed out on.
It is, yeah. It is, in my view, an important middle ground. Yeah. So if you get into this field, you don't need to learn cryptography. You don't need to know how it's actually done and the code that needs to be written and the kind of, you know, advanced computer science things. At the same time, there is a wealth of information on YouTube that is really promoting all kinds of schemes. We have tried to address this by creating a curated sets of 1-hour videos that explain it from the point of view of an asset manager, a compliance officer for a family office. What would she need to do in order to minimize the risk for her institution? And this is like somewhere in between. Yeah? There is the discussion about how much should be allocated. Like, because there are funds that do nothing else but speculate on tokens, and they buy very early over-the-counter wholesale, and after that they don't really care about volatility because they already got their 600% in 1 year win. But that's a subset, and I think that the people on this call are not in that business. There is an allocation that can be determined, and you see that happening all over. Yeah, it's happening at 1%, 2%, 5%, and there are large asset managers that can provide that kind of service, or you may become one.
Thank you, gentlemen. Thank you, Luis. We're past the hour by 2 minutes, so I will call our workshop to an end. Thank you all participants in the audience. Mircea, Kevin, much appreciated. Luis and Johan, thank you again for organizing. Yeah. And I look forward to the next workshop on digital assets to educate even further people. So have a great day. Take care.
Good meeting you all. Thank you. Bye.
You.